Okay, I think I have a few more people join in. Nabil, do you want to do a quick reintroduction and has Manwar bhai join in as well?
Sorry, what did you say again, brother?
I said, has Manwar bhai joined already or no?
No, I did call him. He did say he's joining. I think he's having some technical difficulties, but no worries. We can continue on.
Okay, I think I have just started the recording. So for the recording purposes, again, we have the W2 Beyond W2 webinar going on, and I'm going through the four buckets of income. Okay. So we talked about the earned income, we talked about the portfolio income, how that would essentially a dollar earned comes in your pocket is 70 cents. Passive real estate. So if you have rental income coming in and you are taking the general depreciations, usually what that means is that you should be able to make it an even, and you should be able to get to a dollar earned and a dollar kept, meaning $1 rental income should translate to a dollar rental income coming in your pocket. And if you're not doing that, then you might be paying some taxes, which could be the case if you're earning a really high amount of income through rental. Usually it's a rare case, but generally speaking, people are able to keep that dollar. Then we have the fourth bucket, which is for active real estate people, people who are actively participating in real estate through either themselves or through somebody in their family. They actually also have the capability to have the dollar earned and use depreciation strategies to even offset other earned income. So a dollar earned could eventually give you some tax brackets and some depreciations that would essentially offset your earned incomes as well. And for today, we'll be talking about the passive real estate and the active real estate buckets. Again, deductions and losses must match the bucket they are meant to affect, meaning if we are taking passive losses, then it would offset passive income. If we are taking active losses, then they will offset active income. So essentially what I'm trying to say is that number three should be able to offset number two, and number four should be able to offset number one. And then now I want to pass out to Nabil to walk us through why real estate is different compared to other asset classes and how a dollar earned in real estate translates to what comes to your bucket and what is actually taxed.
Thank you for the.
Nabil,
Um,
your voice is
can you hear
echoing.
me now? Is
Yes,
it
go
good
ahead.
now? Okay, beautiful. All right. So, like most other math equations, especially when it's related to income, you have really two variables, right? It's how much you make versus your expenses. Now, real estate, the reason why it's such a tax safe haven and you get so many people in all different asset classes, right? Or income types. You have W 2 earners, you have company owners, all these different pools of people that invest in real estate is because of the one additional component to it. So, what makes real estate is different is that the equation equals rental income minus the operating expense, which could be your taxes, your mortgage, all these different things, plus another deduction that you guys get, which is the depreciation. So you got rental income, operating expense, depreciation, and that's what actually equals your taxable income. So I'm going to give you guys a very simple equation, and then I'm going to ask Manwar Bhai to speak on this a little bit at the end of the slide. But let's just say in this scenario that you guys, right? I'm going to take a random name here, brother Abdul Oseni. You made $20,000 in rental income from your first real estate investment. Now your operating expenses was around $15,000. That might include your mortgage, your taxes, your insurance. Let's say you had some repairs, you paid an agent to do leasing, a property manager, you had to cut some grass, maybe some utilities. All of things total, it added up to be about $15,000. Now you've got $20,000 in income, $15,000 in expense. Now you've got a net rental income of $5,000. Traditionally, for most businesses or other incomes, you would pay taxes on that $5,000. But on top of the actual operating expenses, you get an additional benefit, which is called depreciation. So let's say you bought a property for $100,000, you depreciated 10% of that in the first year, And we're going to talk about different types of depreciation and how we can do that. But you've made net $5,000. You've depreciated it $10,000 on the asset. Not only did you keep your $5,000 net income as dollar to dollar in your pocket, but you also carried $5,000 in depreciation forward to other buckets of, passive income and so on and so forth. So that is why real estate is so different. Your cash might be moving one way, but your tax is moving another. So in short, you're making money while not paying taxes, and maybe sometimes not just only not paying taxes, but using it to save taxes elsewhere. Now, for a lot of you guys, let's move to the next slide. Depreciation is a new thing. How does depreciation work, right? Depreciation really has three different pillars. One is the building itself, then you have the land, and then you have the components. So, in plain English, when you buy a property, you're not just buying one single property, you're buying components to it as well. The property itself, the structure, that's the building. The land is what the property and the structure sits on, and the components will be things like, for example, specifically your furnace, your hot water tank, your windows, it could be your appliances, and all of these things depreciate completely different. All right. So we've got a question here. This is a good question. Brother Abdul asks, can we depreciate or take the depreciation for W 2 income? Manwar Bhai, if you don't mind answering that. Manwar Bhai, can you hear us?
Yes, I can.
So a brother asked the question, can depreciation be used to deduct W-2 income?
Okay, there is a very good question. So depreciation first use, as you gave an example for a rental income. For example, that person earned $20,000 rental income, and operating expenses. He was able to management fees, property tax, mortgage interest, insurance, all this stuff. He was able to deduct $15,000. But on top of that, there is a depreciation expense. Okay, so depreciation expense is also applied um, towards the rental income. For example, the depreciation is now $5,000. Then that person even out his net profit is zero. Okay, based on the property, if the depreciation is now $7,000, for example. Okay, so now the $2,000 is a passive loss. Is considered passive loss. So if there is a W-2 earner, W-2 earning is considered as an active income. Okay. So in order to use that $2,000 loss towards, so there is no such thing as depreciation. That's why I'm trying to give you the scenario, because depreciation is used towards your real estate income or real estate. If you have a building, you didn't make no rent, nothing, you bought it, you renovate it, first couple of years you can use just a depreciation. It's a loss, so it's a passive loss. So if that person, W-2 earner, actively participate in the real estate, there is a rule of certain hours they have to dedicated to real estate, then that person will be able to use that as an active loss. So in that case, their W-2 earner, whatever the real estate loss they have, they can use it towards their active income. Okay. Also, for example, let me give you another scenario. For example, a person is a doctor and engineer. Okay, and that person has a high earning because they're getting W-2 earning. So that's considered as an active income, but they have a multiple real estate properties that's showing depreciation and all this, even if they're making income. But the depreciation, what does the depreciation do? Depreciation, depreciation is a paper loss, which is used to um, to towards the rental income or real estate income to reduce your income, and lot of time is give you a great tax break. So back to the scenario, if a person is an engineer, have a investment of two, three multiple property, but the wife also, the spouse can be a real estate professional, because when they're filing tax together, okay, so it's basically they're filing jointly. Maybe there is a, I mean, wife doesn't have no other job or something, she can get a real estate professional certificate or something, or she can actively participate in real estate management, and then that person can use all of the real estate laws towards their active W2 income. So I don't know. I'm just giving you too much information in order to answer it uh, properly, because there is no depreciation loss. It's a real estate loss. Depreciation is a component that used in real estate for all other expenses. Okay. So technically,
Absolutely.
for example, the first scenario Nabil gave in a rental property, technically you're making that $5,000. You made it. You made that profit. But when you're filing the taxes, you are able to use the depreciation towards it, and you are able to forfeit it. So you are not paying no taxes. Okay. But if you have loss, then loss carry forward. For example, the other scenario, if that person has an active income and there is no active participation in real estate, then if that person make that real estate loss with depreciation and everything, that cannot be used towards the active income, but it can be carry forward also. It can be carried forward to the next year for the another passive loss, you know, another passive income. For example, you didn't use it that passive loss this year, it will carry forward next year, and the following year you might be making more money, and then that loss will first deducted from your income in the following year before you pay taxes. I hope I answered the question.
I think so. And simply to summarize it, yes, you can use, real estate losses to offset W-2 active income, but under certain rules, right? And if you guys want to know specifications or how you can do that, please feel free to reach out to Manwar Bhai, and he can help structure that out for you guys in the future. But the short answer is yes, but with conditions. Now we've got some other questions also that have come up. We're going to answer those towards the end. We don't want to stray away too much, but we will get to those questions. So again, the depreciation has three components. One is the building, the land, and then the components in it specifically as well, like the furnace, the hot water tank, and so on and so forth. And when you combine all of these strategies together, you're able to maximize the depreciation. And a question here for, some of you guys have been to both New York and Detroit. Land cannot be depreciated, right? What do you think has more value in land? Is it Detroit or Manhattan? And for all of us, the answer is technically Manhattan, and it usually is. In these type of scenarios, I try to mention this to highlight the fact that we have such a golden opportunity here in the Midwest, in the city of Detroit, where really the building cost and the components is where all of the value is. The land does not have a substantial value, and land cannot be written off anyways. So you get a major tax advantage depending not only on how much you invest, but also where you invest. This is a major component to understand for you guys. All right. So, what is cost segregation? Okay. I'm going to give a quick example and an explanation, and then I'm going to ask Manwarbai to also add to it. What it is a study done by a professional engineer. It's someone who comes out and identifies each component, its lifespan, its recovery periods, and what the property facts support. Why does it matter? It changes the timing. It may accelerate getting additional tax benefits in the earlier years, which can improve, your tax obligations and reduce that burden. It is not an escape valve. By doing this, does not completely just get rid of the passive losses completely. there's conditions to it, there's loss rules, basis, at risk limitations, and then there may be future depreciation recapture. So, Manarba, if you can speak on this a little bit as well, on how cost segregation works and what it may look like for them in the future.
Okay. Yeah. So in real estate, the depreciation is basically is the main advantage, taking depreciation. And cost segregation is basically your personal properties inside the building. As Nabil said, the land, you made a very good point. The land never get depreciated, right? So, for example, if you make a structure, a building, the building get depreciated in 27 and a half years. So, for example, if you buy a real estate, uh, for example, for $100,000, you are getting a depreciation of 3,000 something in the first year. Okay, but in that house, you have structure, you have appliances, you have carpet, you have your furniture and fixture. So those are considered like personal properties. That can be that's cost segregation. Like for example, you kind of identify how much your appliance cost, how much is carpeting, how much furniture and fixture. So you are kind of segregating your costs, personal properties inside the building. And why you are doing that? Because you are doing that to get additional special depreciation on that. Some of the item can be depreciated 100%. Based on the recent tax code, you can depreciate it even 100% in the first year. So now your depreciation expense is getting higher because of the cost segregation. Because your appliance get depreciated in 5 years, okay, 5 to 7 years, where your building is depreciating 27 years. So obviously, if you have a $1,000, like for example, if you have furnace $2,000, you are able to depreciate in the first year $2,000 uh, in that cost segregation rule. So that's giving you more room to save money on real estate.
Exactly. So, Manwar, my question for you: what is the maximum depreciation in a year? Give like an example of someone you've helped with doing cost segregation. Just a rough number. Let's say I invested $100,000. I did cost segregation. How much do you think I can depreciate the first year if I do all of this?
Okay, so for example, now, like if you invested in $100,000, if you do the cost segregation, obviously the building is giving you 27,000. If you do like generally, if you just identify your carpet, carpet can depreciate in 7 years. Same thing, 5 years, your 5 to 7 years, your appliances. So you are basically able to depreciate about 15, $20,000. Like I mean, in $100,000 property, $10,000 at least. Fast.
At minimum.
Yeah.
And what about maximum? Have you seen people do 25, 30% depreciation in year one?
25, 30%.
Yeah, is that possible even?
No, it depend on the like the value of the your value of the item that you are
Yeah,
depreciating. Yeah. So but again, like that $100,000 you invested, for example, in the first year, you didn't make no rental income, nothing. That obviously that $10,000 is a loss. It's a passive loss. You can either use it if with active participation, you can either use it to reduce your active income from W2, or the passive rule, you can move it forward to the following year, the $10,000. So you're gonna second year, you're gonna make some rental income, and you can minus that $10,000 plus the
understood.
second year's depreciation.
Beautiful.
So I mean that's how its depreciation works.
Okay,
So obviously the property value is higher, your depreciation is higher.
beautiful.
Yeah.
Okay. All right, let's go on to the next slide, Brother Fassi. All right, I've got a quiz for you guys. So we've provided a lot of information. I don't want you guys just to be listening. I want this to be actually practical. So far from the questions and from the information provided, the question here is, what does depreciation really do? All right. Does it guarantee tax-free income or create a non-cash deduction that may reduce taxable income, eliminates all capital gains tax on a sale, or D, it provides and always offsets income? So I'm gonna just give a second for you guys to answer.
B.
All right. So Alhamdulillah, Alhamdulillah, everyone has caught on very quickly, and it absolutely is B. You can go ahead and reveal the answer. I wish I could guarantee tax-free income. That would be a dream for all of us. And unfortunately, there's no way to guarantee it, but with proper structuring, there is a way to significantly bring it down. And sometimes I've seen almost zero, including even this year, Manwar Bhai has helped me significantly reduce my taxable income by offsetting, it with depreciation and different losses. And it's not, only real estate. When you really sit with a tax planner, you'll see things like, even depreciating a vehicle. Each vehicle has its own schedule. So lots of ways to do it. But in terms of an actual investment that gives you not only cash flow and appreciation where your property value is going up, but also tax benefits, real estate is your safe haven in that. All right, Fasibai, I will pass it back to you. You're on mute, I believe. I can't hear you.
Oh, I have to add something
Okay.
on that. Uh,
Sure.
about this, for example, we talked about active income, WT income, all that. But when there is a like high income person, the tax bracket is also very high.
Yeah.
So as Nabil asked me before, like how much they can save is based on the person, because a person is a very high earning like taxable income, their tax bracket is 37%. So that person saving is more, even if it's $10,000 depreciation, giving them more tax saving than a person making $100,000. So you have to understand that, because tax bracket is also come into play based on the earning. Okay.
Per-
Absolutely.
Yeah.
Perfect. Can you guys hear me now?
Yes.
Okay. Thank you, Manwar Bhai. So moving on, again, it's exciting to see how depreciation can help us. We want to make sure that we also have these check boxes for taking passive losses. So basically, these are the four tests to make sure that it is a loss that can be taken. Firstly, you need to have income. Like if you don't have income coming in, obviously there is not taxes to offset. The second is it has to be at risk. Like depreciation really is basically saying that I have economic risk of keeping this and it is not an asset. It will depreciate over time, and henceforth I'm able to take that depreciation. Third, it needs to be specific to the bucket or the income bucket, like Manwar Bhai was talking about. Rental income properties, they offset passive income, and passive losses offset passive income. Active losses offset active income. So in order for us to, let's say, do the W2, you gotta have something like he was mentioning about having a real estate professional in the family. Fourth is also seeing that, hey, if I have these losses, I may not have enough income to offset. Maybe I need to carry forward. So instead of keeping it for this year, I can carry forward. Manor bhai, how far can we carry forward our losses? Is it to just next year or the year after?
No, it's accumulate, and as long as you don't use it, it's go to the next year and the next
Perfect.
year. Yeah.
One of the things I have noticed is that people have their equities vested, and they want to sell those stocks, the company stocks that they receive. They want to time it according to how these losses are taken. So if you are having an event, let's say your company gets acquired or something, and you are expecting to have a huge amount of stocks that need to be liquidated, it's best to plan it out and carry forward losses to that point or that year, so that you, when you liquidate those um, uh, stocks, which is a passive activity, you can take these losses to offset that. And essentially, what I'm trying to say is that K1 losses may be useful, but may not lower this year's W2 tax. So you have to plan that out accordingly and make sure the active is offsetting active and the passive is offsetting passive. And then next thing, obviously, we were talking about this whole aspect of real estate professional status. Um, Manwar bhai, I would love you to talk a little bit about it, but I am giving some information here. Essentially, what it's saying is that somebody is putting more than half of their personal services during the year in real estate property trades or business in which the taxpayer materially participates, and which is translating to about 750 hours of service a year, which they're actually maintaining, like, property leisures, doing some property management, anything that's related to property, and that would be considered as a real estate professional status. It could also mean you could take a real estate agent license and you're helping others get into real estate. Norba, you want to add anything on this?
No, that's about right. So if you calculate it, 750 a year, 750 hours you have to put throughout the year in as active participation. So if if divide it by week, you are putting about like 8, 9 hours in
Yeah.
real estate, and
So,
that can be a material participation, active participation, and you will be able to use that loss.
Manorba, I just did the math and it equates to 14.4 hours a week.
Yeah,
One
probably.
thing, yeah, one thing I want to mention here, guys, is that 14.4 hours a week is not a lot. Even if you were to buy one or two investments and you're factoring in phone calls with your realtor or going to Home Depot to pick up material or just visiting the property site, talking to the tenants. Again, a lot of these things can be, services that you get as a basically services you can hire out for, but by keeping yourself involved to a certain extent, it can really make or break how much you guys get to keep. So I would ask that all of you guys who are high income earners look into it. And yes, real estate license is a way to help make that, more sensible to the IRS, but it doesn't have to be. I have many friends and associates and people that have already invested with me that have done this where they've buying multiple properties and they're documenting how just by communicating with me and property management and whatnot, it has become pretty active for them. So as long as you have record of that and it's legitimate, you guys can absolutely use this to offset W2.
Yeah, and if you guys have any questions, do put them in the comment section. I am not viewing the comment section, but Nabil, please keep an eye on that.
Yes, so I'm gonna take the two questions that we have. One from Brother Zia: do they need to be licensed? No, not technically. Does the spouse just having a real estate license be sufficient, or would she have to prove the minimum work hours? I think we answered that here, just showing 750 hours in the whole year. That's the two questions that we have currently.
Okay. Perfect. And then the next thing is just basically showing an example of how a K1 loss is different for different people. Like I said, they could be passive real estate, they could be active, depending on everybody's situation. There are ways to offset things and you can take benefits. So first thing is, hey, you're a W2 earner, you don't have the time to do essentially active real estate. You can have somebody else take care of it, and then take these passive losses and offset your passive income. Then you have the registered professional thing that I talked about it, and you basically have your spouse or your adult son or children be real estate agents or real estate representatives, and they are keeping the books. They are maintaining that 750 hours a year. Then that automatically makes all of that real estate income and losses to offset your active income. Third is basically you just have passive income coming in, then it's pretty much straightforward. You can take passive losses to match that. The question is, which one are you? Depending upon where you are in your positions and your work. If both of the family members are working, probably it's best to have hired a real estate professional take care of all your real estate, and then whatever you earn through, let's say, stocks and other dividends could be offset. If you have the possibility to have some of your family members become real estate professionals and put in the time, then that would really activate it to be considered as active income. Next, again, I have a quick poll here to just check on how everybody's doing. Can passive rental losses usually offset a full-time W2 income taxes? I believe questions did answer that, but let's look at the options. Yes, always. Usually no. Only when facts and rules allow. D, I'm not sure. So if you can quickly put it in the chat, which one do you think it is? Nabil, can you let me know? I hope
We've
everybody
got
answered.
B, C, B, C. So between B's and C's,
Okay.
let's reveal it.
Oh, I don't have it actually, but I think what I do know is essentially it's a poll. So basically, it could be usually no or C, only when facts and rules allow. In this case, it's basically C. When you have the real estate professional status, then yes, you can offset it. But if not, then usually no. Okay, so this is really interesting. I basically did like a very generic example of case scenarios of three different people and using three different routes in real estate to take tax benefits. So starting off is a very simple, basic $100,000 household income. Traditionally, you receive $100,000. You might put out some of it for 401k, HSA, and then you're not doing any real estate, you're not having any other investments to take given losses in real estate. So basically you have no depreciation, cost segregation, and you don't get any tax credit for those. But technically you have no tax savings, so you pay whatever tax bracket you're in, probably around 20-25% of your income on top of the 13k that you're saving for your 401k. Then you have somebody who is an active investor, not really an active real estate person, but he's an active investor. So he knows that I need to put some in stocks, I need to put some in rental income. So he goes and buys a $100,000 property, puts on $20,000 as down payment, and takes a 10k deduction on it. Which shows about $15,000 in depreciation, does not do cost segregation. And then basically what it does is it gives him the credits of about 25,000. So he can estimate, safely say that he could save about $5,000. Um, so what I'm trying to say here is that this is significant when it comes to just holding real estate in your portfolio. And I'm not saying you need to be actively in it, it's just holding some passive income through real estate. The third scenario is where you become like a real estate operator. You do have W2 income, but then now you have somebody in your family or yourself putting in that 14 hours a week. You are able to go ahead and get a hold of a better property, let's say at 250k, take those same losses, do the cost segregation studies, and then now you basically double your tax savings and go to like almost $12,000 in tax savings. So again, and one thing I did not mention here is that you're actually increasing your income as well. As basically here is cash flow potential, so you can have up to $4,000 in additional coming in, aside from that $5,000 saving. And then if you are a real estate operator, then you can have $10,000 in cash flow coming in with that $12,000 saving in. So it's really changes the whole game when you're looking at it in real estate.
And one thing I'll mention here is that oftentimes I run into lots of realtors who are in this industry. And, oftentimes it's also a wife. And when I talk to them and I get to know them better, it seems like they don't really put a lot of energy or effort in and whatnot. And their spouse is usually extremely significantly successful. And me being in the industry for the last 10 years, I would think to myself, like, man, this lady doesn't need to work. Why is she doing this? She's, not putting a lot of effort or commitment, but she's still, doing some business here and there. And now, as I've gotten older and I started to understand the regulations and whatnot, I'm like, man, you know what? These people knew all this information so long ago. There's a reason to everything. She doesn't have to be, but the benefits are why usually you see those kind of dynamics in family households.
Perfect. And so the next is a $200,000 income. Same scenarios, you have a diversified portfolio, which is what I recommend. You can see tax savings going up to $15,000. And then, really, if you become a real estate operator, you get to essentially hold real estate at higher values. And you're able to do that because of the knowledge you have. And then you're able to offset even higher amount and bring in more income to your house. So when I started by saying getting into ownership of assets, and this is what I meant by it. By owning assets, you're not only maybe slightly seeing the cash flow coming through rental income, but really with the added benefit of the tax savings, it's basically doubles your potential and brings. So just to give you some math here, a person just having a 200K income is giving in taxes, and there's no other income coming in. But if he starts holding some real estate, you see that he gets to make $10,000 on as rentals, plus he gets a saving of 15,000. So essentially, his net upside is about 25,000, and that significantly improves when you are a real estate operator, going up to almost like what $65,000 plus. And then I increase it to 300,000. Again, this thing changes significantly. Same scenarios, diversified investor seeing upwards of about $45,000 in net proceeds, and then all the way up to 120,000 plus coming in the house. So it really changes the picture of how you're going to earn.
We have a quick question here. Dr. Afaq, with cost segregation, I understand the first year depreciation is high. What about the subsequent New Year's? Yes and no. If you do take pretty much all, if not most, of the tax benefits in the first year, then yes, definitely will be lower in the following years. But as long as you can do it systematically and you're buying enough real estate, like for example, let's say I buy one asset every year, you have one new property to do significant depreciation on. You just have to plan it. But if we're talking about just one property specifically, let's just say on $100,000 asset, I took 50% depreciation somehow on my year one, then yes, the following year on that one asset would be a lot less in terms of the tax benefits you could take.
And actually, that leads into my next question here. And I think a general question that comes to mind is that, hey, this is all great. This is taking into account that we have depreciations and cost segregation studies. What happens when we sell these assets? These assets have now appreciated. When I sell them, I'm going to have to pay capital gain taxes. How are we going to fix that out? And so for that, I have this next slide. What happens on capital gains in real estate? So you have basically two options, and it's basically rolling it over. So when you sell an appreciated asset, you have to recognize the gains, right? You bought it for cheaper, you sell it in 5 years, you gain $100,000 on it. The idea behind it is that you could, if you realize it, then you do need to pay taxes. But hopefully by that time, you're mature enough to see that the benefit that real estate comes in, and you have two options. One is do a 1031 exchange. What that means is that you can defer this gain of real property held for business or investment in exchange for a like kind real property, meaning you bought a house for 100,000. After 5 years, you sold it for $200,000. But that same year, and again, there are some specifics. Manoj, I can talk about it. And that same year, $200,000, you buy another property that is for $200,000. Then you don't pay anything in the capital gains. Manoj, you want to explain on the 1031 exchange?
Yes. So the 1031 exchange is basically, as you said, is you defer your taxes. So the real estate gain you earn from selling a property, you can invest in a likewise asset again. And instead of paying, for example, if you make $100,000 capital gain, you bought $100,000 property, you sold it for 200,000, you have a net capital gain of $100,000. So in order to avoid that, avoid paying that gain tax on that $100,000, you can buy a likewise property, $200,000 property, another property, and then you can build a generational wealth basically,
Yes.
without paying any taxes. So you can distribute that money. The condition is you have to reinvest it in the similar project, similar likewise properties. And also there is a rule that you have to you have to find a property within 180 days. You
Yes.
have to reinvest it. So you have to do your due diligence before you selling the property. What are you going to do with the money, in order to do that?
Yes.
Yeah.
And of course, for all of these things, you do need professionals to help you out in making sure that the timings are right. You need accountants, you need real estate professionals who can help you make sure that you're able to do these things in a timely fashion and take the most benefit out of it. There is one more thing that I want to talk about is the opportunity zone. And in fact, the whole of the city of Detroit is in an opportunity zone, is investing in a in a structure or a building that's in the opportunity zone. And I think you need to keep it for, I believe
Nine,
it's 9 years.
9 years.
Yeah, 9 years. And if you keep it for 9 years and then you sell it, then all the capital gain that you get on it is tax free. So you get to keep it without having to pay anything.
And I just want to give a quick example of both. I deal with a lot of different investor clients that ask these questions. In regards to the opportunity zone, I just did a syndication with a few investors for an apartment building. And the partners were, having a back and forth on, hey, how soon do you guys want to exit? We've left it to discussion and discretion of the investors, but unilaterally everyone agreed that, hey, we'll wait at least 9 years, because it doesn't matter that we bought it for 400K and we're selling it for 800K in 9 years, because it's an opportunity zone. We pay literally zero in taxes. So being able to do that, it's just amazing in itself. And then like 1031 exchanges, real life scenarios I've worked with, or when people have bought multiple single families along their journey over a couple years, and then maybe they're selling these and 1031 exchanging into an apartment building. So they're moving up asset classes and saving their cash flow and their capital gains, and also improving what they own as well. So lots of ways you can do this. And if you guys reach out to us or any other professionals, they will be able to help you. Dr. Afaq, you asked the question, is 1031 exchange unique to real estate? Yes, it is.
Okay, so moving on, and then I'm going to wrap up here in 5 minutes, is some questions to ask your CPAs in about getting into real estate. Is how do we get into this K1 income, K1 loss, passive, whether it will be passive or active for you. So that's something you need to identify. Do I have passive income that can absorb passive losses? What are my bases and at-risk limits? How will, again, I will be putting these questions in a document and sending it out to you guys to discuss it with your CPA, so you are not leaving anything that's on the table, and making sure that you review everything out. So that's like, how will depreciation affect current taxes and future recapture? So a lot of people think that they're taking depreciation, but they're not able to think about how you can carry forward that and be able to take that in the coming years as well. How does this affect state taxes? Again, this could be unique to your own states. They might have different benefits depending upon where you're investing. What happens if distributions are lower than taxable income? This is also an interesting one. Like if you have distributions coming in like rentals or dividends, if it's lower than the taxable income, how do you benefit from that? So this is like a download gift that we'll be providing to all of you guys. Do check your emails. It should come in hopefully by Monday to you guys, and check your spam folders as well. And it's a very good questionnaire that we have prepared for you guys to have, and it should have a summary of all the presentation that we have given today as well. Okay, so the final questions I come down to is, this is all great. I see that we have to get into real estate, but there's a lot of questions on where these assets are and how to find it. Like, how do I know that this real estate investment is a good for me? Is it something that I can do on my own? Can I maintain these? Because I know a few of us over here have had real rental properties, and some of them have gone through eviction process. Some of them have had horrible times with tenants and finding tenants. So it's not that easy as it seems to be. So there is a lot that goes behind it in times, in the process of finding the exact assets that are clean, that will give you income and won't give you more headache than what you can take. and what is the strategy on how to find it. Nabil, do we have any questions in the chat before I go to the next section and
So
talk
there
about?
is a question in regards to Fajr Fund, which maybe we can stick around a little bit to answer. But let's continue on for now, and then we can get to the questions later.
Okay,
So
so go ahead, Nabil.
yeah, so we wanted to talk about the opportunities. We've mentioned Detroit here, and the reason being is that this is where we focus ourselves. We will only give guidance and recommendation on things that we have been in and have worked with. Why Detroit? There's a few different components: scale, affordability, access. It's just simply a large housing base. We have prices that are below the national replacement cost, so meaning you can get a house for 100,000. To build that house, it might cost 200. There's a lot of fragmented ownership, and local relationships really go a long way. As well as for a lot of you guys that care about being riba free and these types of concerns, Detroit is a great market to be able to come in at affordable cash bases. Population is 650, 140 square miles, $1,074 in average rent, average purchase price of $90,000. Just to give you guys an idea, in the 1950s and 60s, Detroit housed 2 million people. And this is where it's going back to. We've had, after 5 decades, 6 decades of population decrease, 3 consecutive years of it going up. And you should ask yourself, can I do it on my own? Can I do it with getting advice from realtors and other professionals? Absolutely. Both of these are possible, but the questions that you need to ask yourself is, did I understand enough? Do I have enough time? Do I have enough experience? And really determine what's best for you. Now, where is it that we can help? On top of being the CEO of Fajr Fund, I am a broker and owner of Amin Realty. Me, Fasi, and Mustaq have a property and construction management company together. So a lot of different angles, but in short, I can help you find the right asset with my team. We can help you provide the resources with proper tax planning and also be a part of that because we're also representing you on the investment. So we'll kind of point out those things as we're going through the process. And it's very, very fortunate that we know that information for not only ourselves but for our clients. And then, of course, maintaining and selling the asset. And most important, what we pride ourselves in is truly focusing on this debt-free model. Debt-free doesn't always mean that you have to buy it all yourself in cash. We do have many investors that are like-minded that we can syndicate you guys with in a deal, that you guys can bring friends and family together. You can invest in, silently in our funds. So many ways that we can do that. So this is a little bit about our companies. So Amin Realty, as I mentioned, we've been operating for over 10 years now with over $1 billion in sales transactions. Alhamdulillah, we have about 100 realtors as well. Omni Property Managers, which does the leasing, the operations. We currently have 90 doors. We've done over 100 construction jobs, from medium to large, and then countless maintenance jobs. I can't even mention how much. And then we also operate a SEC registered fund, which is basically, the income fund model that we're launching, where we will have debt-free passive income. We currently have under FF1, which is Fajr Fund 1, $2 million in assets under management, and we're looking to raise $10 million for the next round. So, inshallah, there is definitely ways that we can help you. We have the, resources, and, these are some of our companies: Omni, DMTA, Fajr Fund, Amin Realty. Feel free to take my information or Fasi's, reach out to us and book a individual call to really understand better. All right, guys. One last poll, just so we can help you guys learn as much as possible. What do you guys want us to go into next? A, passive loss planning; B, cost segregation; C, 1031 exchange; D, real estate professional status; E, private fund diligence; and maybe anything else that comes to mind. But we want to continue doing these sessions on a weekly basis. Next week, I believe we're going to do one on why just a $3 million stock portfolio isn't enough. We've got A and E as an answer. Anything else? Okay. So yeah, again, thank you guys for all of you guys who joined. Hopefully this was
If,
informative.
if if there is anything you guys want to ask, I think we can take about another 5 minutes for questions. You can unmute and ask questions to us. Will be wrap up at like 1:10, let's say. And if you
Yeah.
have any questions, yeah.
Brother Abdul, I believe you have some questions about Fajr Fund. Yes, we can take some time to answer that now. Feel free to go ahead and unmute yourself and then ask away.
Assalamu alaikum. This is Abdul.
So,
Wa alaikum.
I just, I originally found this on, I found this on LinkedIn, and my background is I'm a physician, based in local Kentucky. I am originally from Nigeria, so I have a younger brother is a financial specialist in based in Toronto. We have a lot of real estate prospects in Nigeria and emerging economy. We also have a microfinance bank back in Nigeria. It's pretty much a single unit community credit union. We also have an insurance sec registered company that actually does sukuk structure. So, but I've been from an emerging economy setting. I've been very focused on doing things outside the US because of trade collaborative and all that. So I've just pretty much, but I've always looked into real estate. This kind of opportunities are presented here. Unfortunately, people tend to target people like me on LinkedIn, so I got tired of it. It's every day, like physician groups that, friend, you see an emergency room physician, friend you accept the friendship, and the next thing is, hey, how's your practice going? Hey, my practice is going well. Hey, you want to talk about multi residential estate? Oh, we have $276 million. I looked at it, they tell me that, oh, we've been able to distribute 7% or maybe $3 million, and do the math and see that they have about 300 people. Do the math, it's like $20,000 total for the last few years. It doesn't make sense to me, basically. So then beyond that, I didn't want to work with, I wanted to work with people who had the same spiritual orientation as I did. So I pretty much just shut them down. If I say it, I just ignore. Like, that's what I've been doing for 2 years. But when I saw yours, I wanted to listen because it's something I wanted to invest in, but I've been avoiding investing in certain people. So that's why I wanted to hear more about the Fajr Fund, your
Absolutely.
in reality. I just want to know. I want to start investing in the US. What I was actually going to do was buy a $50,000 house near Oklahoma University in Oklahoma City, just renovated, right out. Somebody was doing that, and I was like, "But I don't have time. I'm an interventional cardiologist. I literally do not even have time for myself, not to talk of having to eat." So that's why I wanted to hear more about the numbers. I gave you my background because I'm a numbers guy. I know one or two things about finance. I know one or two things about
Yeah.
STEM. I know one or two things about how this process works. I've just not translated that in the US.
Absolutely. So one thing, about our company is that it's very simple and easy to understand. The Fajr Income Fund, which is basically the next fund that we're launching, we're currently not open at the moment. Inshallah, we will launch in the next 2 to 3 months, and we can keep you updated for that. But in short, it's on a few simple pillars. It's debt free, vertically integrated, meaning that we do everything from acquiring the properties, leasing it, managing it, so on and so forth. We're focused on one type of asset class, which is residential, and residential meaning single family homes, multifamily homes, and apartment buildings. We only specifically house families and individuals as well. It's not commercial or it's not complicated. What we offer is an 8% preferred return to our investors, paid out on a quarterly basis as cash flow. So on average, on these lower ticket investments, let's just take one single family home here in Detroit. We can buy a property for around $75,000 and rent it out for $1,200. This is very common, but what we do is specialize in finding deals that will have equity or growth opportunity. We specialize in managing and maintaining those properties. In short, it translates to about 9 to 10% in actual net cash flow after everything. Our structure is very simple. We give our investors 8%. Anything on top of that is basically rent that the general partners get to keep. So that's simply what it is, right? There's about 9 to 10% cash flow.
It's a 5-year lock and 50-50 on the equity.
Yes, 5-year lock. So you invest for a period of 5 years, and then these properties do go up in value. As of right now, Detroit's been appreciating at about 8%. We're underwriting 3 to 4% per year in appreciation. On that, you're going to get 50% of that cash or of that appreciation. So when it translates to bottom line for you as an investor, 8% cash flow. Let's say you invested $100,000, you're going to get about $8,000 a year paid out quarterly, and then about 2 to 3% additional in appreciation. So your IRR comes to be about 10 to maximum maybe 12%. And that IRR, appreciation gets paid out at the end when you exit on top of your capital. That's it. That's it. Very simple.
That's fantastic. So you're looking for $2 million.
So the goal is $10 million, and we're going to raise it in $2 to $2.5 million amounts. And the reason why we're doing that is because just you, Brother Abdul, giving us the money isn't going to be sufficient. We need to be able to place that capital. So we actually launched another company prior to this, which was Fajr Fund 1, and that company's goal is to buy, fix, and sell. And in short, it's stabilizing a lot of these assets for the income fund, as well as, of course, the resources we have through our brokerage, other agent connections, wholesalers, and whatnot. But why we're raising $2 million increments is because that's what we're ready and confident to deploy in short periods of times.
So, over what duration are you looking for the $10 million?
Over 9 to 12 months at maximum. And it might be shorter, just depending on how quick we can raise it. But I would say if we raise $2.5 million in,
Each quarter.
every 2 months, each quarter, that's sufficient. We should be able to safely deploy it into, strong assets.
Yeah, that makes a lot of sense.
And just like these webinars, we're having conversations. We've got some soft commitments already from investors, and it is first come, first serve. So, if we, for example, have $4 million in commitments come in now, we're not going to accept it all because we can't deploy it that fast. So we're planning on doing to 2 to 2.5 million in tranches. And that's really our goal at the moment. Also, just so you're aware, Brother Abdul, investing through your IRA or retirement accounts is an option because we are an SEC fund. So many investors are considering that as well.
Okay. Historically, how many uptakers do you have for $2 million amounts?
What was the question, brother?
Historically, how many uptakers do you typically have for a $2 million figure?
How many investors would there be?
Yeah.
Usually it would be about 20 investors. On average, our minimum investment amount is 50,000. For this type of fund, on average, we're expecting at minimum $100,000. We do have some conversation with like endowments as well. Alhamdulillah, here in the local Michigan community, we built a very strong relationship with pretty much all of the masajid. And some of these masajid are planning on investing 400,000 or 500,000, from their savings accounts for basically a waqf or endowment for their organizations. But aside that, an average investor, individual, might be investing about 100,000 to start with. Yeah.
What tax documents do I get at the end of the year?
You will get a K1 statement. So just like we talked about in this session, that there are tax benefits that does go to you guys as a pass through. So basically, especially for years 2 and 3, more than likely you're going to get a good negative K1, and then following years, as we're starting to minimize the amount of depreciation we can take, you might start getting positive K1s towards the end of the 5-year investment.
And what happens at the end of 5 years?
At the end of 5 years, really, we're planning on, of course, inshallah, doing this continuously. Our goal is to get to $1 billion in the next 10 years as debt free assets under management here in the US. But you will have two options at that point to either, inshallah, if Allah gives us the opportunity to continue investing with us, or you exit and you take your money back and do what you see fit.
Okay. Last question. If I have a lump sum, accidentally I sell, or I decide to sell a property, and I happen to have $500,000 for no reason, and I don't know what to do with it. Is that something, or $1 million or $2 million? Is that something you're willing to accept? Because I heard you don't, there are certain targets you don't want to go over.
Yeah, we are willing to accept any amount as long as it's within our quarterly maximum. So, for example, right, brother, we want to be fair to everyone. We may have multiple investors that committed 100K, 200K, 300K. Let's just say we have $1 million in commitments at the moment. And you say, Brother Abdul, Brother Nabil, I want to invest $1 million. We can take that, but not to exceed the $2.5 million per quarter. That would be the maximum total per quarter that we'd take.
And you said you want to launch this at the end of September-ish?
Yes, so we're currently going through our legal structure. Probably by the middle or beginning of middle of August or beginning of September, we will be ready to collect capital and deploy. And in the meantime, we are taking soft commitments.
Okay, that makes sense. Yeah, like I
And
said,
there will be other opportunities, as we've mentioned, there are tranches where every quarter we're going to open up, up to $2.5 million. So we have many people that have already invested with us, either individually or through Fajr Fund One and other options. And a lot of these people, their intention is to start with, one, two, $300,000, and every quarter add to it. So just because you invest in the first round doesn't mean that you can't add capital in the following rounds as well.
okay, that makes excellent sense, and I really appreciate your time and everything the information you've given.
Absolutely.
That was the last question, but I had one more comment. So, quick thing, if and this is just a wild idea.
Yes.
Instead of having commitment, like I'll give you an example, and I think everyone on this call is trustworthy. So I get my bonus every September end. The last paycheck in September, I get a huge bonus. So I can pick that bonus and invest it. That's not the problem. But it might just be easier for somebody like me, at least speaking for myself, if why not put, let's say, $7,000 every month into the fund, something like this. So if you can come up with an architecture like that, I think that may appeal to some other people. At least I can say that for myself. So it's just something to think about.
So there's two issues with that. One, by receiving these small increments, it's not as simple. Like we have to, like, for example, buy an asset at $70,000, $80,000. Sometimes people might deploy that capital to us, but it's still not sufficient for us to buy an asset. And now they're expecting a return on that. So that's one actual, fund